Zack Apoian, you are increasingly cautious about European stocks. They've really come back since the Brexit sell-off. So what unnerves you the most?
Well, that's right, Greg, and we're very encouraged that they have come back not only in Europe but across the world from the initial few days when we had the difficult sell-off. But we don't think we're quite out of the woods with Brexit. At some point, the UK will trigger Article 50. It won't be this year, but it's coming. And when that happens, it opens a large, very public negotiation among all these heads of states that are elected officials. And we just think the sound and fury that will come from that will certainly weigh on markets, and it will hit Europe the worst. And so we think on a forward-looking basis, there certainly should be volatility in the future. And for that reason alone, we're cautious on that.
Well, right now, most of the worries are surrounding European banks, especially Italian and Portuguese banks. So what's going on over there?
Yeah, so we've seen the stocks struggle for some time, really since negative interest rate policy took hold. And so, looking just back to on Friday, we got some results from the European stress tests. I think you can say it roughly met an extremely low bar. We did see some dispersion. Some banks are faring better than others today. And so, I think it'll remain a concern. I think most of all, there are some banks that, if there were a stressed event today, they would be out of capital. And so, in the past, the ECB's been they've taken very aggressive measures in order to protect. But at the same time, this is still a risk, something we need to watch.
Meanwhile, however, the valuations are in Europe's favor. They're cheaper than our stocks, so why not go in there and do a little buy-in?
Absolutely. So Europe, we have around 14 times forward earnings versus about 16 times globally and 18 times for the US. And so for that reason, we think over the long term there is value. Our concern is more over the short term. So, we think based on the valuation, it does warrant some position in your portfolio. We have it as an equal weight, but for the time being, we're concerned that kind of the value won't be fully realized until some of these other obstacles are out of the way.
And you are actually positive on emerging markets, and they've actually started to outperform U.S. stocks over the course of 2016, which has been a big turnaround. Why do you like emerging markets more now?
Yeah, that's correct. So we've certainly warmed to emerging markets. It's a call that takes some fortitude. They've underperformed virtually this whole cycle, but as you say, they've outperformed this year. And so the way we think about it, really, there's the macro headwinds that have held them back. Things like the dollar having its really strong run in 2014 and 15, the oil collapse over the last year, they've started to kind of relax more. And so the dollar's been stable for a year, oil is off of its lows, and we're seeing some of the more idiosyncratic pieces in a number of these countries really start to come back. I think one other thing worth mentioning, kind of the slower pace of Fed hikes will help a lot of these emerging market nations, which are really dependent on global liquidity and financial conditions.
All right, well, thanks a lot, Zack.
Thanks, Greg.
And thank you for watching The Street.